The Philippine Stock Exchange is the only equities exchange in the country. It is one of the oldest stock exchanges in Asia, tracing its roots from the establishment of the Manila Stock Exchange in 1927 and the Makati Stock Exchange in 1963. The two exchanges were unified in 1992 to form the PSE we know today. It currently maintains a trading floor at the PSE Tower in Bonifacio Global City, Taguig City. The PSE is a venue for companies to raise capital for business expansion. As of end 2020, there are 272 listed companies at the PSE. The PSE also serves as the marketplace for investors looking for equity-based financial instruments. It helps investors build their wealth as stock investments have the potential to grow over time. Investors make money in the stock market through price appreciation and dividends. The PSE helps maintain a fair and transparent market through its continuing disclosure requirements for listed companies. Meantime, its independent subsidiary, the Capital Markets Integrity Corporation, oversees and regulates trading participants. Trading at the PSE is open Monday to Friday except on holidays. The PSE currently observes shortened trading hours from 9:30 a.m. to 1 p.m. Investors who would like to invest in stocks will need to open an account with any of the 126 accredited stock brokerage firms. Visit the PSE website at www.pse.com.ph or follow our official social media accounts to know more about investing in the stock market. Welcome to PSE Stock Market webinar. Our topic for you this afternoon is investing in real estate investment trusts or REITs. We are glad to have you with us. So before we proceed to the webinar proper, let me share with you a short video that we have about the product. Real Estate Investment Trust or REIT is the newest product in the Philippine stock market. This asset class has long been offered in other bourses, but the Philippine stock market has finally caught up with the signing of the revised implementing rules and regulations in 2020. REIT is creating a buzz among investors because this instrument makes it easier for individuals to invest in real estate. Instead of putting in big cash on a property investment, an investor may opt to diversify into real estate by being a shareholder of REITs. A REIT is a stock corporation created for the purpose of owning and managing income-generating real estate such as office buildings, residential condominiums, shopping centers, hotels, warehouses, hospitals, airports, and tollways. Because REITs are publicly traded and listed as other companies, buying a REIT is similar to buying a stock. Several benefits come from investing in REITs. REIT investors enjoy a reliable and steady source of dividend income as REITs are required to give out 90% of distributable income annually as dividends to all its shareholders. REIT investors enjoy the liquidity of REIT shares as they can easily buy and sell through the stock market. REIT investors can diversify their investment portfolio with REITs. It allows investors to invest in a wide range of property types, including retail and industrial properties and various infrastructures. REIT investors can ensure that there will always be transparency and less perceived investment risks, as REITs are subject to increased disclosure requirements. Investors may invest in REITs through these three steps. Open an account with a REIT-eligible stockbroker. Authorize your stockbroker to create your name on Central Depository or NOCD account. Subscribe to REIT IPOs via PSEEC or buy listed REIT shares in the stock market. Visit the PSE website at www.pse.com.ph and select Real Estate Investment Trusts under Products and Services to know more about the requirements for investing in REITs. Now that you know more about REITs, you can now evaluate whether this instrument fits your investing style and will help you achieve your investment goals. There you have it, guys, a short intro video about REITs. So I hope the video has increased your interest on the product. And of course, our resource speaker this afternoon will give you more info about it. Our resource speaker is the head of equity capital markets of BPI Capital Corporation. He has over 10 years of experience in investment banking. So prior to joining BPI Capital's equity capital markets team, he worked for CLSA Exchange Capital Inc., where he participated in 20 landmark equity, debt, and financial advisory transactions. Ladies and gentlemen, please help me welcome Mr. Jerome Gatmaitan. Good afternoon, Jerome.
Good afternoon, John. First of all, thank you for having me here. And I'd like to also thank the Philippine Stock Exchange for inviting me. It is a pleasure to be here. And I'd also like to thank the participants who are watching this afternoon. I do hope that you learned something from our presentation and from the Q&A that we will have later on. So what we have here is a brief presentation, an introduction to REITs, basically, and the way that we'll show the presentation is that we'll start off with an overview of REITs in the Philippines, and then we'll talk about regional REIT markets and their performances over the last couple of years, and we'll also talk about why invest in REITs. Then we'll talk about how to evaluate REITs. And then we have here a case study on a REIT, which is the first REIT here in the Philippines. So let's start with an overview of REITs. What is a REIT? A REIT is a real estate investment trust. It is a stock corporation that invests primarily in income-generating real estate assets. It has to have at least 75% of its deposited property invested in income-generating real estate assets. There is a dividend distribution requirement. At least 90% of its distributable income has to be declared as dividends to investors in order to avail of the corporate income tax exemption. There are allowable investments in REITs. These could be real estate and real estate-related assets, government securities, commercial paper, mutual funds, and securities issued by local or foreign corporations. It has to be a public company and listed on and traded on the Philippine Stock Exchange. There is a leverage limit for REITs. The total leverage cannot exceed 35% of total deposited property. There are many different types of REITs. On the left-hand side, you can see the more traditional real estate REIT type of assets. You have office REITs, retail REITs such as malls, residential REITs such as condotels, hotel REITs, industrial REITs such as technoparks or data centers. And over time, you've seen some of these REITs combine into different types of diversified REITs. So some REITs could be a combination of office and retail REITs, or some REITs could be a combination of office and industrial REITs, or a combination of residential and hotel REITs. Further along, we've seen also other infrastructure-related REITs, such as data centers, toll roads, airports, utilities, and other renewable energy type of REITs. So this is a typical structure of a REIT. So you have the REIT corporation in the middle. Below that, of course, you have the assets of the REIT. It could be a single asset. It could be 2 or 3 or how many more properties or assets for the REIT. Above that, you have the shareholders. Based on the latest IRR, the minimum public ownership has to be 33%. So the public could be composed of a combination of institutional investors and retail investors. Then the balance would, of course, be held by the sponsor. On the left-hand side, you can see there are 2 other companies that are here, the fund manager and the property manager. The property manager is really in charge of the physical upkeep of the assets of the REIT. It makes sure, of course, that the elevators are working, the escalators are working. It makes sure, of course, that there's no window that's broken. So it's really in charge of the physical upkeep of these assets. Whereas the fund manager is the one that really helps execute the acquisition strategy of the REIT Corp. So what is the difference between investing in bonds, common stocks, and REITs? So investing in bonds, bondholders receive regular interest payments until the bond's maturity date. At maturity date, they receive the bond principal. So on the leftmost chart, you can see that the initial investment of 100 in year zero. Then in the succeeding years, these are the interest payments. So in year one, you could receive 5, year two, another 5, year three, another 5, and at maturity, you get back the principal of 100, which you put in at year zero. For investing in stocks, common stocks don't always pay dividends. Stock prices also may increase or decrease depending on the company's growth or the market conditions at that time. So in this chart below, you can see that the initial investment of 100 in year zero. In year one, you don't know if the company will pay any dividends, so that could be 0. Year two, the company could pay some dividends, so you could have an example here of 8. Year three, these dividend payments could be 2. And then the stock price at the end could either be higher or lower, of course, depending on if the company grew or the market conditions at that time. So we don't know. Investing in REITs. So REIT shares are common stock with high dividend payout. As I had mentioned, the REITs are required to distribute at least 90% of distributable income. So again, stock prices also may increase or decrease depending on the company's growth, among others, and market conditions at the time. So here you have an initial investment for REITs of 100. In year one, you could have a potential dividend payment of 5. And then year two, this 5 could increase to 5.25. And year three, this could increase to 5.50. And of course, given that the stock price could go up or down, depending, of course, on the performance of the company and market conditions, it could be up or down depending on the share price at that time. So what's the difference also between REITs and property stocks? So in terms of distribution policy, as I had mentioned, REITs are required to pay out a minimum of 90% of its distributable income as dividends, but contributing to a potentially high dividend yield. Listed property stocks aren't required to have a dividend policy, but some property stocks do still pay out dividends. In terms of earnings profile, as we had mentioned before, at least 70% of the REIT's assets must be income generating. So that means that the cash flows are more secure and more stable, and the rental income could be more stable. If you compare that to listed property stocks, the portfolio could be more diverse. So your revenue stream could be coming from potential recurring income, could be also from property sales, from the sales of condominiums or units. It could also be also from property development. So the earnings profile is a little bit more different than that of REITs. In terms of risk profile, of course, you have a lower risk profile for REITs, given that these assets are more mature, and the risk profile, of course, for property stocks, given that you have a mix of property and development, land bank, property sales, that could be a little bit more volatile than REITs. On the leverage side, there is a defined level of gearing for REITs, as I had mentioned, based on the REIT IRR. If it's unrated, there is a max of 35% of total deposited property. In terms of taxation, of course, for REITs, it may avail of income tax exemption if at least 90% of its distributable income is paid out as dividends. And for listed property stocks, they're required to pay a corporate income tax. So let's see how some of these REIT markets have performed over time. Of course, we'll start off with the history of REITs. REITs really have been here for quite some time. It started off in the 1960s in the United States. And in Asia, you have Singapore, which listed its first REIT around 2002. And in Hong Kong, it had its first listing in 2005. As you recall, the REIT law was passed sometime in 2009. And last year, we had a first REIT listing, which was a REIT. India also had its first listing in 2019, and Thailand also had its first listing in 2014. So REITs have been here for quite some time, and we've seen the development of the REIT market in these regions. This is a very interesting chart. On the upper hand side, you can see the market caps of Singapore, Malaysia, Hong Kong, Thailand, and Philippine REITs over time since 2002. And then below, you can see the number of REITs per country since 2002 of these respective countries. You have Singapore by year-to-date 2021 with about 37 REITs, Malaysia with about 17 REITs, Hong Kong with about 12 REITs, Thailand with about 24 REITs, and of course the Philippines with their first REIT last year. It's interesting to note that in terms of the total market cap composition, we can see here that the two biggest markets for REITs are Singapore and Hong Kong. Even though Hong Kong has only 12 listed REITs, in terms of market cap size, it's part of the top two in terms of the aggregate market cap size for the regions that we looked at here. We also looked at the performance of regional REITs over 7 years. We'll start off with Singapore. We looked at the 7-year total return of Singapore, and we compared that to the REIT indices and property indices and the equity indices for that time period. So you can see on the left-hand chart that REITs, which are in white, clearly outperformed property stocks and equity indices in the equity index of Singapore over a 7-year period. In terms of total return, the REITs are at 87.99% compared to property stocks at only 9.55%, and the equity index at 24.23%. If we look at Thailand, the case still holds true that REITs perform better than property stocks and the equity index over a 7-year period. We note that the total return for REITs, which is in white, is at 54% for Thailand. For property stocks, it's 16.16%, and the equity index is 43.6%. For Hong Kong, it also performed better than property stocks, and it kind of tracked the equity index for Hong Kong. So REITs, in terms of total return over a 7-year period, is about 70.23%. And for property stocks in Hong Kong, it's about 48.46% compared to the equity index of Hong Kong, which is about 74%. We also looked at the breakdown of the different types of REITs in these countries. If you look at the left-hand side, we start off with Singapore, with hospitality REITs performing worse than the other types of REITs. And we can see here that the ones that really perform better are the industrial and healthcare REITs in Singapore. Office and retail only doing slightly better. Retail a little bit below its year-to-date performance. For Thailand, we can also see here that hospitality is quite down. Office is down. Industrial is not as down as the rest of the REIT indices in this particular market. For Hong Kong, we also note that the retail and office REITs haven't been performing as well. Hospitality, on the other hand, has done better than the office and retail REITs for this particular country. So why should we invest in REITs? So REITs have the potential to unlock the value of a sponsor's property portfolio. It also simultaneously can raise cash for the sponsor's growth prospects, while also providing investors with a new inflation-hedged instrument with attractive returns supported by dividend yields and dividend growth. As you can see on the left-hand side, the sponsor can contribute, its income-generating properties. Ideally, these are mature income-generating properties to the REIT co, which already can also distribute dividends. And after that, the sponsors can generate cash from the sale of the REIT or the IPO of a REIT, and use this cash to develop other assets which the sponsor could potentially inject into the REIT vehicle or create another REIT vehicle for those particular assets that are now more mature. So REITs allow property companies to tap into new sources of capital. It can also help unlock the value of its properties. On the investor side, it could be a stable inflation hedge investment for investors. It could be a help, with the. It could also provide attractive total returns in terms of dividend yield and growth, and also it could also give investors participation in an upside for assets at affordable ticket sizes. So these are some of the factors that enable REITs to be inflation hedged. So some of the contracts that the tenants may have with the REIT company, for example, if it's an office REIT, some of these contracts could have built-in rental escalation clauses. Some of them could be 5%, some of them could be 10%, or a mix. So there could be built-in rental escalation clauses in the contracts of the tenants with the REIT co. And these lease terms could be long, and by long we could see these lease terms as long as 5 to 10 years. And of course, the rental rates and property market values have been steadily increasing over the last few years. What we have here on the right-hand side is a historical inflation chart, and we also compare the office rental rates. And what we want to show here also is that the average inflation rate here is about 2.9% since January of 2011. So let's say your built-in rental escalation rate is about 5%, and your average inflation is about 3%. Then this 2% differential could help you with this inflation, and we can consider this as an inflation hedged investment. There are also some REIT characteristics that might appeal to more conservative investors. As I had mentioned, some REIT characteristics could be that they have high dividend yields supported by the 90% dividend payout requirement. There are leverage restrictions with the REIT IRR. As I had mentioned, it's 35% of deposited property if unrated and 70% of deposited property if rated. It gives investors exposure to cash-generating real estate assets with contracted cash flows. And of course, some of the contracts could have built-in rental escalation clauses. And as I had mentioned earlier, some of these contracts could be medium to long term. And these contracts could be, let's say, for example, 5 to 10 years, which could support the cash flows for that period. REITs, as I had mentioned in the beginning, have to be listed and traded on the Philippine Stock Exchange. REITs can be are affordable, and you can buy them at affordable ticket sizes. So let's say the share price range for the REIT is around 5 pesos per share. Multiplying that with the minimum lot size of about 100 shares, one can own a REIT for about 500 pesos. So one can own 100 shares of the REIT at 5 pesos per share for 500 pesos. This is a very important concept that we'd like to illustrate here, which is the concept of total return. And by total return, we mean the dividend yield plus your dividend growth. How do you get your dividend growth? Your dividend growth can come from the built-in rental escalation clauses of the contracts of the tenants. It could also come from potential asset enhancements. So, for example, you have a building of initially 5 floors, and then there was a major asset enhancement for that building, which increased it to about eight or 10 floors. Therefore, the potential increase in the floor space could yield a higher the dividend yield growth. Another way that it could also increase the dividend growth is through potential asset acquisitions. So on the left-hand side here, we illustrate kind of like a build-up for this total return calculation. So for example, if you have a dividend yield of 5% for the REIT, and then you have a contracted rental escalation, the total return here could be potentially 7%. As I mentioned, the assets could undergo asset enhancements to help increase the dividend yield growth. So that could potentially add another 2% in this example. And then the REIT vehicle may choose to grow the assets. And because of the potential acquisition, this could yield an extra 4% dividend yield growth. So adding all those numbers together could yield a total return of 13% in this example. So you start off with your dividend yield of 5%. Then you can tack on an additional 2% for the rental escalation, then another 2% for the asset enhancement, and 4% for the asset acquisition to come up with a total return of 13%. So how do we evaluate REITs? Of course, it's good to understand the contracts that the tenants have with the REIT vehicle. It's good to understand if there are built-in rental escalation clauses. How long are the lease contracts? In terms of the REIT vehicle, will there be land, or will it just be the buildings in the REIT vehicle? Another thing to think about also is what could be the potential growth story of the REIT? Will the sponsor be able to grow the REIT? Will the sponsor be able to make sure that the REIT vehicle isn't a depreciating asset, and that in 5 to 10 years down the line, this REIT vehicle could grow? And of course, what are the prevailing interest rates during this time? I think that's a very good consideration. And the next few slides will also talk about some other considerations to think about. Another thing to think about is, of course, the sponsor. Is the sponsor a significant shareholder in the REIT? Does the sponsor have a track record in real estate acquisition, management, and development? Does the sponsor have a great understanding of the local real estate market? Do they have access to a client network? And about the management team, are they experienced professionals? Have they been exposed to this type of real estate development? What's their experience like? So I think it's important to also think about who the sponsor is and what the sponsor has achieved over time. Other things to think about for REITs, as I had mentioned, the reputation, the track record of the sponsor, I think is key. Of course, what are the macroeconomic factors or conditions during this time? Are there any rental escalations built into the contracts? What are the occupancy rates of the buildings that are part of the REIT vehicle? Are they at 90%? Are they at 100%? Now, in terms of the tenants, are they high quality tenants? Is there tenant concentration risk? What are the length of the lease terms? Another thing to think about also is where are the properties of the REIT located at? Are they in prime locations? Is there potential for capital appreciation? And of course, another thing to think about also is what is the financial health of the tenants? Are the tenants able to pay on time? Will they be able to pay on time in the future? Do they have how have they performed over the last couple of years? Have they been repeat customers to either the sponsor or the REIT vehicle? I think those are some of the key things to think about also when you think about investing in REITs. So what we'd like to show here also this afternoon is a great case study, which is the first REIT of the Philippines, which is a REIT. It listed in August at a share price of 27 pesos per share. It slightly dipped in the early part of its trading, and it slowly recovered. A REIT announced on August 25 that there will be a dividend of 31 centavos per share. And then slightly 2 weeks after, a REIT also announced the acquisition of Teleperformance Cebu. And on October 23, it also announced another acquisition, which is the 30th Mall. And it also, on November 3, it announced its third quarter earnings. On November 17, we can see the share price track this. It also announced its dividend of about 34 centavos per share. And we can see the share price slowly climbing up. And on December 28th, A-REIT disclosed also its investment strategy. And on Jan 6, A-REIT announced the acquisition of 98,179 square meters of land. And since January, we've seen the share price go up to about 34 pesos per share, all the way from the IPO price of 27 pesos per share. This is a great example of how the share price has performed over time. A-REIT has regularly announced, of course, its dividends, how much it would declare as dividends. It also seems to show that it delivered on its growth promise with, of course, the announcement of the Teleperformance Cebu, the acquisition of that, and the acquisition also of 98,179 square meters of land. So the disclosure of these dividends, coupled by the acquisitions of Teleperformance Cebu, the 30th, and the most recent one, the land acquisition, helped also the stock go up, and it shows really to investors that A-REIT is a growing stock, and it's performed pretty well over the last couple of months. Now, also what we'd like to show here is also the total return of A-REIT since its listing. So as we can see here, the total return is around 25.92% in terms of total return for A-REIT since its listing. So it's a very, very, very great performance by A-REIT, and BPI Capital is proud of this transaction and of A-REIT and its performance. That ends our brief presentation. Again, I would like to thank the Philippine Stock Exchange and John for inviting me here. I do hope that everybody learned a thing or two about REITs from this presentation.
Thank you very much, Jerome, for that end-to-end presentation about REITs. So if you want to get in touch with the PSE, our contact details are in the screen right now. Email academy@pse.com.ph. For corporate information, please visit the PSE website at www.pse.com.ph. For disclosures, PSE Edge. edge.pse.com.ph. If you want to know more about investing, there are investing materials at the PSE Academy website. Please join our online community. We are on Facebook, Instagram, YouTube, and Twitter. Of course, here in our Facebook page, we have our webinar series playlist. So just visit the video section and click the subscribe button so that whenever we go live, you get notified. So we have two more webinars for you this first quarter on March 5 and March 19. That's stock trading operations and building a healthy investment portfolio, respectively. This is John Garcia from the PSE's Market Education Department. I'll see you all again next time.